My friend Marcus, he's 29, works in tech sales in Denver, sent me a screenshot of his portfolio last Tuesday, down 23% in 6 months. "Should I sell everything?" he texted. "Everyone's saying this is just the beginning." I stared at that message for a full minute. Because 3 years ago, that was me, March 2020. My portfolio was hemorrhaging money. Tesla down 60%, Apple down 30%, every financial news show screaming about the end of the world. My neighbor Steve, retired accountant, supposedly new money, told me to cut my losses before it gets worse. So I did. I sold everything, $34,000 worth of stocks at the absolute bottom. You know what happened next? The market roared back. By December 2020, the stocks I'd sold were worth $71,000. I'd literally paid $37,000 to learn the most expensive lesson of my life. Here's the thing. Everyone thinks contrarian investing means buying when others sell. That's not even close to the real secret. Real contrarian investing isn't about market timing. It's about timeline thinking. Let me tell you about Sarah Chen. She's 41, works as a physical therapist in Portland. In March 2020, while I was panic selling, Sarah was doing something completely different. She kept her regular $200 monthly investment going. But here's the twist. She added an extra $50 every week. The market dropped more than 3%. I figured if toilet paper was on sale, I'd buy more toilet paper, she told me 6 months later. Why wouldn't I do the same with stocks? But Sarah had something I didn't. She understood the 18-month rule. The 18-month rule is simple. Any money you invest, you cannot touch for 18 months minimum, not 12 months, not until things get better. 18 months, no exceptions. Why 18 months? Because that's how long it takes for the average person's emotional brain to forget the pain of a market crash. Think about that for a second. Most people's investment timeline isn't based on companies or economics. It's based on memory. In October 2008, the S&P 500 hit its low point. 18 months later, in April 2010, it was up 70%. But most people didn't see that gain. They were still too scared to invest. The same pattern played out in March 2009, August 2011, December 2018, and March 2020. Every single time. 18 months from the bottom, the brave got rich, the scared got poorer. I learned this lesson the hard way. After selling everything in 2020, I spent the next year watching my former stocks soar while I sat in cash, paralyzed. The real contrarian edge isn't analytical, it's psychological. Here's what I discovered. There are two types of investors, renters and owners. Renters think like tenants. When the building shakes, they want to move out. They're always looking for the exit. They measure success by how little they lose when things go bad. Owners think like landlords. When the building shakes, they wonder if they should buy the apartment next door at a discount. They measure success by how much they accumulate when others panic. The difference is timeline. Renters think in quarters. Owners think in decades. Now, here's where it gets interesting. The stock market isn't designed for renters. It's designed to transfer money from renters to owners. Over any 18-month period, the market might be up, down, or sideways. Over any 18-year period, it's been up 94% of the time. That's not luck. That's compound ownership. Let me give you the numbers. From 1950 to 2023, if you invested $1,000 during the scariest month of each decade, October 1957, May 1970, October 1987, March 2009, March 2020, you'd have $47,000 today. But only if you had the 18-month rule. Only if you could stomach watching that $1,000 sometimes become $600 before it became $47,000. Most people can't. They rent their investments, they check prices daily, panic monthly, and sell within the year. The real contrarians? They're the ones buying rental properties when interest rates spike, starting businesses during recessions, investing in stocks when everyone else is running for the exits. They're not smarter, they're just operating on a different timeline. Marcus texted me back after I explained this. So you're saying I should buy more right now? Wrong question. The contrarian question isn't, should I buy more? It's, can I leave this money alone for 18 months? If the answer is yes, buy. If the answer is no, don't. It's that simple. Because here's the truth nobody wants to hear. Every dollar you invest scared is a dollar you'll sell scared. Every dollar you invest with a plan is a dollar that might make you rich. The 18-month rule forces you to invest with a plan. Now, if you're someone who checks your portfolio more than twice a month, if you've ever sold an investment because everyone's saying something bad might happen, if you think of your stocks as pieces of paper instead of pieces of businesses, this is for you. The next time the market crashes, and it will crash, remember Sarah Chen. Remember the 18-month rule. Remember that real wealth isn't built by avoiding the storms. It's built by dancing in the rain while everyone else runs for cover. Tonight, before you check your portfolio again, ask yourself one question. Are you investing like a renter or like an owner? The answer will determine whether the next crash makes you richer or poorer.